us today is Richard Banks, the editor of Insurance Day in London. Richard, are you with us?
I am indeed, Frank. Hello.
Good. Hello. Good morning for us. Good afternoon to you. Thank you for taking the time to speak with us today. Richard, I've been following your articles over the past few weeks talking about the ramping up of capital into Lloyd's. And if I could maybe just go through the hit list, and this is drawn from an article that you ran on Friday under your byline. The total now we have that I've been able to count is Kiln with 125 million pounds of new money, Beazley 150 million pounds, Hardy's 40 million new pounds, Chaucer 75 million new pounds, Omega 130 million new pounds, and there's another one here for I guess 200 million new pounds. That's Catlin, and the total then is 720 million pounds, which is a little bit over 1.022 billion US. This is quite a reload, I would say. Would you not?
Absolutely. I think there are a number of reasons for this. Clearly, the exchange rate, foreign exchange situation is such that some of these companies are going to need a little bit more money in that. But at the same time, there's a real confidence in the Lloyd's market that the market is turning to such a degree that they want to be positioning themselves to take advantage and to have that capital there with which to address the rate rises that they're actually expecting to see.
Do you think that much of this, as you mentioned with the exchange rate, is due to the U.S. escrow trust funds that they're forced to put up?
Well, it's difficult to say at this stage. Certainly the claims aspect of it is going to be something that is forefront in their minds. Whether that particular issue is one that is going to be driving this, I don't know. I think it's probably unlikely. I think a lot of this is done through letters of credit, and so I'm not sure actually how much physical cash they have to put up for these things.
Okay, because I was going to say that I'm sure they're following that discussion over here about the collateralization requirements for quality reinsurers with the NAIC. So, I mean, presumably that would have an effect if they did, in fact, have to raise this money to escrow.
It's certainly true that they're following it very closely, and I think that there was celebrations at the end of last year when they felt at last that there were some moves being made. I think everybody is being realistic as to how quickly the situation is going to move forward, and being realistic as to actually how quickly it will be before any physical changes are felt. I mean, I think that it's fair to say that the new administration in Washington has got other things on its mind other than that particular aspect. But it's certainly true to say that there were some celebrations over here when the NAIC came out with its new framework.
Well, I agree with that. Just as an FYI, last night President Obama was interviewed on the CBS 60 Minutes Sunday night television show, and in the course of the interview, when you were talking about having other things on his mind, he said to the interviewer, he said, "Who would have thought a year ago that the Iraq War would be the last thing on my plate right now?" So that goes to show how some events can supersede what your best laid plans are. But let me ask you a question. One of the other points that have been coming up in your articles is not quite too articulated yet, but there, not that somebody like me at least was able to spot it. You're talking about a little bit of a contrast between the money that's being raised for capital markets type of alternative vehicles for reinsurance as compared to what seems to be an eagerness to throw more money at these traditional reinsurance vehicles, i.e. syndicates. And you had written an article back in mid-March, and I just want to pull this quote right out. It was from one of the sources in the article, and in which you said it's not quite a zero correlation between cat bonds and other assets in the financial markets. This of course, is really a little bit of heresy, and the person who spoke this was actually somebody from the financial world, because the cat bonds had always been sold, or if you will, offered on this idea that they were completely uncorrelated in terms of risk. And that market has now, with some spectacular failures, seemed to have gone into a treading water kind of mode. How do you see the ease of capital for these two respective markets in the risk area?
In terms of traditional risk transfer and the cat bonds.
Exactly.
Yeah. Well, I think it's fair to say we've seen with the score announcement a couple of weeks ago that there is some activity in the cat bond arena. It's very different from the sorts of programs that were being put together in the past. There's very much clearer transparency in terms of the counterparty and the way that they're structured. When we look to perhaps the more traditional aspect, it's interesting that companies like Amlin were able to go back to their traditional names to find some capital for a reinsurance project that they were working on. It's also interesting that in this latest story that we did on Friday about Kiln, that their new unit is being provided as a reinsurer for a sort of intra-group reinsurer for their ultimate parent, Tokyo Marine. So I think that it's fair to say that there are opportunities from the newer cat bond style projects, but I think at the same time what we're more likely to see is that the traditional reinsurance arm is going to be very powerful this year.
I would say so. Let me go off script a little bit and ask you this one final question. As you know, these AIG bonuses over here have attracted much consternation amongst the Main Street types as well as everybody. And I noticed an article this morning saying that the Dutch over at ING are pleading with the people who have received bonuses to return them voluntarily, and Societe Generale has even jumped on board asking the same of their executives. I just have to ask you this question because people ask me this question all the time about AIG. The American government standard answer for AIG is that it's too big to fail, and that if it ever went under and we stopped supporting them, the whole system would collapse. If somebody asked you that question at a cocktail party, I mean, what would your answer be? You're sitting right there in the cockpit, so to speak, of Lloyd's and hearing everything. I mean, if AIG was a company that had the plug pulled on it by the government of the United States, I mean, would the catastrophe be as far-seeing as the Treasury Secretary has said?
Well, it's a very, very good question. It's a very difficult question to answer. I think that there are a number of things that would have happened without a shadow of a doubt. Firstly, that people's confidence in the insurance industry as a whole would be severely dented. I mean, I think it's probably fair to say that it has already, and perhaps you and I might agree that it's rather unfair the way that the insurance industry as a whole has been tainted by its association, if you will, with AIG. At the same time, whether you can say a company is too big to fail, I think it's a very difficult question as to where you draw that line. We as you'll be aware, of having our own problems in the UK with bonus scandals and calls for people's bonuses and indeed pensions to be curtailed and withdrawn. And so we're very much in that same sort of boat as you guys are, I think.
Mm-hmm. I don't know. He's gone. Stop filming. Well, you can cut it, right? Later on.